All right, all right, all right. Good morning, everyone. Good morning. We are going to try something new today. No microphone. How does that work? No microphone. I got this new headset thing here, and it's got this little microphone on it right here. Somebody was complaining yesterday that the sound wasn't good, and I went and looked and watched the video yesterday, and he was right. The sound had something wrong with it. So we spent about, probably an hour and a half last night trying to figure out what was wrong with the sound. And apparently, something with the new update to the software we use to project live into YouTube has a problem with the sound equipment that I own. All my fancy sound equipment doesn't work with the new version in Firefox. Now I use Firefox instead of Chrome, and so that was the problem. So now I'm going to use Chrome today, and I'm going to try using this new little microphone and see if you guys can give me some feedback to see if you think it sounds any better or worse or something. We'll keep working on it and trying to figure something out. But all my fancy sound equipment is sitting over here on the side of the desk, not being used while I use this new gamer headset. They said gamer headset. Talk to David Duty. This is what he uses, and people seem to like it. So we'll try it. No mic. No mic though. That's actually kind of nice. I can see everything a little cleaner without all that stuff in front of me. I just hope that it sounds good to you guys and that it works well. Uh, Certainly not the quality of headset that I was using. Doesn't sound very good to me, but I guess what it sounds like to me is not as important as what it sounds like to you. So, all right, let's get started. I got a really good class today. We're going to talk about, I made, well, I always hate to brag about how much money I made. But I made a couple $1,000s yesterday. I thought that was pretty good. I know. You got on YouTube and guys, oh, I made $25,000 today. I make $25,000 every single day. All right, well, go watch that guy then. I'm not that guy, but I did make a couple grand yesterday, and I was going to show you how I did it. And I've been promising that I was going to show this strategy um, for some time. I've showed it once before, and we've gone into some great detail on it. But I just thought I would show you a quick place to maybe, well, I'm not going to tell you where to put your money. You put your money wherever you want to put your money. I'm just going to show you where I put it. All right. And then I'm going to show you what happened and why I made a little bit of money yesterday. So, one of my favorite places to trade, but we're going to get to that not first thing. We're going to save that for a little bit later. First thing we're going to do is we're just going to kind of do our morning ritual here. We're going to come through and we're going to pull up Firefox. And we're going to look at Firefox and we're going to look at the economic calendar. Let me bring this thing full screen here. How do I do that? Right here. So I want to look and see what the market's doing today. We're going to refresh, come into Impact 2. We're going to look at countries. We're just going to have this set to United States. And we're going to come back and just take a look. Today's Wednesday. So what's going to go on the news front? So it is now 7:30 our time. We got this set to UTC 6. When do we fall back? When do we change our time? I'm waking up in the morning and it's dark outside, so we're going to change the time here relatively soon, I think. And then 7:15 we had Fed Logan's speech. 8:30 we have crude oil. We could go look at crude oil at 8:30. See if that doesn't move around a little bit. We don't trade crude oil very often, but it's kind of fun when it does work. We like crude oil. 8:30, Fed Barkin speaks. Oh, my favorite, Fed Goolsby. Fed Goolsby on Halloween, month of Halloween. Fed Goolsby speaks at 8:30. I just think that is so hilarious. Fed Logan speaks. Hey, I'm up here in Logan. We're going to have Fed Logan speaking at 8:45. Feds are going to do a lot of speaking today. Look at all these Feds. Fed. You'd think it was January 6th. All the Feds. Okay, that's just a joke, guys. It was a joke. All right. Funny one. It was a funny joke. All right, 10-year note auction coming in at 11 a.m. But our big one is the FOMC meetings at 12 o'clock today. All right. So 12 o'clock, be in front of your computer to watch this thing because the market will probably go jumping all over the place and give you an opportunity to maybe put in some scalps. Okay. And then look at this. Fed Collins speaks, Fed Daily speaks. Man alive, what a rotten day full of Feds. Ugh. Speaking all day long, every day. What kind of a trade do you think we should put on for that? I think we should put on a wild eye, crazy eye, iron butterfly. I do. I think that would be, we want to have it off by 12 o'clock, or we want to have the sold call and put off by 12 o'clock. So maybe what we could do, because these Feds are going to move the market. They're going to bounce it around, but they're just not going to go anywhere, because remember, a Fed guy speaking, all he's going to do is give you political speak. Oh, it's great. Oh, it's bad. Oh, it's great. Oh, it's bad. Oh, it's great. Oh, it's bad. So we're going to see a lot of that. And so that's going to make the market move, be a little jumpy, but it'll probably not go anywhere as we wait for the FOMC meetings to come in at 12 o'clock, which will then move the market. So we want to be out of our sold call, sold put by then, because then we'll have our long call, long put still in the market, and we could watch that thing maybe jump all over the place after we've already paid for part of it. I don't think we'll get the full money if we don't stay in until the end of the day, which brings me up to what we did with our other one, our other trade, our wild eye, crazy eye, iron butterfly. Let me bring that up and show you what happened. All right, here is the last time we did a wild eye, crazy eye, iron butterfly. We did it on the S&P 500, and it was just what? It was a couple days ago. And so we made, right here, it shows $1,000, but that's because notice that the green line, the little snaky thing here, we call this is the price, right, has not made it all the way over to the purple line. So it's got to make it all the way to the purple line to make your full premium. And we held on to it for the whole time. So we made $1,575. Get your pen and paper, because we're going to write some of these numbers down, because I'm going to show you how much money this thing made for us. All right. All right, here we go. $1,575. That's how much that made. $1,575. Now, at the end of the day, how much were we down? We lost on this. Let's come down and get rid of this one, and we'll bring up the next one. We lost 1,045. All right. So we actually lost at the end of the day of this one. It was about 1,045. I think this actually came back a little bit before that next day, and it was actually less than that. But I think this is the sold. Is this? Oh, wait a second. How come this still has the sold on there? Oh, these are both the same day. Where's the one that I had? I guess I didn't keep the. All right, I think it was right around $1,000 that we lost, though. It was actually a little bit less. It was like 900 and something. Let's just put $1,000. Okay, so we made 1,575. We lost $1,000 the next day on the two sold calls and puts. They actually came back. They were down like a little bit more than that. Well, right here they show. Well, this is not the next day. This is still the same day. What the heck? That almost looks like it's the same thing. Anyway, what we did is we made $1,500 on the one that we sold, and we ended up losing $1,000 on the ones that we bought. So our long call and our long put actually ended up losing $1,000. So what happened is we ended up making $575 on that wild eye, crazy eye, iron butterfly after 2 days. And we had to sit over a weekend. If you remember, we held it over the weekend. So it came in on Monday, and that's what we made. Okay. We made it was about $575 on that wild eye, crazy eye, iron butterfly. And we just did quantity one. I know. That guy over on the other channel, he made $25,000. Lan, you only made $5,000 or $500. That guy on that other channel, though, he put in 10 contracts. I only put in one. All right. But we're a beginner channel. We just do things small here. All right. Okay, so let's do that again. Let's put another one on. Let's come in. How would we do that? If we're going to put on another wild eye, crazy eye, iron butterfly, and we're going to play that against the We're going to do it on the, we're going to play it against the Fed. We're going to do it on the S&P 500. So we've done a lot of analysis on the S&P 500. You can see all my drawings in here, where we think this is going to go. Overall, it looks like it's going to be bullish. We don't know, though. We're still looking for it to do this type of a thing, right? I'll just reiterate. This is kind of what we're looking for this market to do. We got nothing down here. We can make the charts bigger. Come on. There we go. Bigger charts. We like bigger charts. Okay, so we're going to take and anticipate this pattern being right here. And it's almost, you know what, almost identical to what that pattern looks like, isn't it? I mean, it's, and to say, well, it's going to take off and go to the moon, I'm not willing to say that. I'm not willing to say that. I mean, look at how this one looks. All this little flat top haircut up in here with all these big topping tails, big bottoming tails. And then after that, it flushed. It turned and flushed down. So if we get that same kind of a pattern up in here, we can get all these little haircuts. Like, look, it almost looks identical to what this thing's doing here. Now, could it flush back down just like it did over here? Or could this one break and go up? It could do anything. It could do anything it wants. Don't pretend like anybody knows what it's going to do, because nobody knows what that market's going to do. I'm just showing you what it's done in the past. It's done this, and then it flushed. And so then it rallied here. This pattern, I mean, that's how we do trading. That's how you trade. You look at the previous patterns, and then you say, well, it's going to probably do something similar to that. Well, if it does, then we might get a pullback. We'll get a little pullback down into the Fibonacci sweet spot. That's all I'm saying. All right. I don't know. I'm not claiming that I know. All I'm doing is telling you what the probabilities are. And the probabilities are that we got a high probability this market could still flush back down. This could still flush right back down into the probability center, okay, into the cone of delta cone of probability is what we call that, right? So let me pull that up just to kind of drive the point home. Here's our delta cone of probability. This is what the Fibonacci ruler is all built around. It's called the empirical data distribution rule. I pull this chart up almost every class and try and remind you that this is what we work off of. This is the key to trading. All right. This is the key to trading. It's probably the single most important chart I have in all of my slide deck, which is probably why I show it the most. All right. It has to do with everything that you do in trading. Okay. This is the option strategy. This is the wild eye, crazy eye, iron butterfly. And look at how that's got the cone of delta cone of probability on it. See that? That's what that is. So when you come in and look, this is what the delta cone of probability is. That's the Fibonacci ruler. So when we go back, when we go back to the charts, I laid that Fibonacci ruler across there. If you want to imagine it, kind of imagine that's where that little, here, I'll draw it. So it comes in like this. And right now, we're kind of sitting outside of that little cone of probability. The high cone of probability is right here. So this market went through that. It's on the outside, and there's a chance it could come back into it and then go create another one. Doesn't mean it has to, right? Fundamentals can drive it further out into a new one, and then we would start a new cone of probability up here. So then your next cone of probability would end up here. I'm not a very good artist, but that's kind of what I'm talking about, all right? So that's how those work. And we generally get 3 of those little cones of probability. So here's one, and then we got the second one, which is right here. And if it breaks out without coming down into the center cone, we would anticipate that it's going to make a third one up here, right? So we would anticipate we'll draw another one up here. And then we have our third little cone of probability up in here. And this is what you would expect the market to do. So little cone of probability, the market will probably come up, come back into it like that. And then we'd get a 3-drive pattern, drive 1, drive 2, drive 3. We really kind of like to see it come down and create that pattern like this. That'd be a little bit more perfect, straight out of the manual, right? If it did something like that. Manual? What manual? What manual are you talking about, Lan? I'm talking about the manual. Don't you have the manual to trading? Everybody should have the manual to trading. It's on YouTube, it's on Amazon. Go get it. Of course, you just have to search Lan H. Turner. That's me. And you can get my book where I wrote all this stuff down for you. And it's not an expensive book, but it's about 235 pages long, 8.5 by 11 that you lay out here on your desk. And it tells you all this stuff that I teach you in these classes because I wrote it all down. For those of you who don't know, I spent about 10 years at the Chicago Board of Trade and Chicago Mercantile Exchange, and they taught me a lot of stuff when I was there. So I wrote it all down, and I put it in that book. All right, so that's what we do here. We look at things I wrote down. I wrote down all that stuff. I wrote down everything they taught me. So I'm here to teach you what they taught me. All right. So there's the Dow. Look at the Dow. Holy cow, that's on the opening bell. We missed that run, didn't we? We were over there talking about other stuff. I guess we're not going to put on our wild eye, crazy eye, iron butterfly. Let's go take a look and see. Oh, we might still be able to. This is a range bar 6 on the S&P. We just need it to come back to the blue line. If it'll come back to the blue line, we'll put on the wild eye, crazy eye, iron butterfly. Well, if it's going to come back to it, why don't you trade it on its way down? Well, we could. Wait and see what happens. This is the Russell. What's the Russell doing? Let's enlarge some of these things. They're not quite so ugly. There we go. That's the Russell on a range bar 25. It's trying to break higher. Range bar Russell, we can usually trade on the range bar 6. Oh, look at that big gap. I don't know if that was a big gap or not. Let me, well, it must have been. Let's see. Let's come in here. Oh my gosh, look at the NASDAQ flushing like a toilet. Wow, that's the range 15, range 50. So, man alive, going back to that daily chart, see that market's making another topping tail up in there. And then it's going to end up looking like this. Wild day today. This might be a good one for wild eye, crazy eye, iron butterfly. We get some volatility and sell that premium. Of course, we got to buy premium too. So when you put this thing on, it's not like, oh, let's really make a lot of money because we got high volatility. Well, you got to buy some too. So it offsets it. You sell some, you get high premium. You buy some, you pay high premium. But we are down here in the green zone on our chalk and money flow. That's a good thing. Let's wait just a second. I think it's going to come down here. I think we're going to see that thing right back down here to it ran up hard, made that nice little double top up in there. Well, I don't know. It's hesitating right here. I think we'll get a little ABC pattern. Let's see if it doesn't come back up. I want to see it back down here, that blue light. If it come back down to that blue light, we'll put on a wild eye, crazy eye, iron butterfly, but not till it gets down there. Let's go see the NASDAQ. So it flushed all the way down. And it's making bottoming sounds down here. Looks like it wants to turn around and go back up. If it were to retrace half or 50% of that last major move, it'd come right back up into that delta cone of probability right up in here. Is it going to do it, or is it going to continue to fall some more? It looks it's getting choppy. It's getting choppy in here. I don't know if I want to put an order on in there to try and scalp anything out of it. It's getting choppy. Was this all opening bell? 7:40, 7:40 a.m., 7:42, 7:43. Yeah, that thing started to flush right there out of the open. Were you guys watching that? Did any of you? Oh my gosh, look at the Dow. Holy smokes. The Dow's on fire. The NASDAQ is flushing, so all the tech stocks are dying. That's been typical lately. The industrials have been doing well, whereas the tech stocks have been suffering. So this is suffering tech stocks. That's not good. I got a little bit of money on those tech stocks. I got a little bit of money on those tech stocks. Wow, look at that Dow go. Why don't you get in on that, Lan? Where? I mean, it's like I wasn't watching it when it was coming in here. Didn't think it was going to run again. We got a couple little hesitations in there. Be more inclined to watch it turn around and come back to the VWAP. Let's tune up this thing. Let's go one. Let's go. 6 is my favorite number. 7, 6. I like it right there. Let's try that. It's creating another little hesitation in here. It's just one big drive. It's not like giving us an Elliott wave pattern or anything. It's just taking right straight off. It's breaking above that pattern. I don't know if it's going to go high enough to give us. We could try it. We just go in small. We'll just go in with. I don't know. I think we're going to see a turnaround here. We'll try it. We'll put one on there just to see if it wants to go up. I don't think we'll get our stop move to break even. It's going to have to move, but we'll see. It's trying to break above that little zoom right now. We'll just put one contract in there just to see what it does. Come on, baby. Come on, Mr. Dow. There he goes. Oh, he's trying to break above the previous high. That's good for us. Oh, tested it. He's not going to let it go, though. Look at that. He's not going to go above it. Hover over exit chart. If it hits negative number, we'll just get out. Wait for it to go again. Hold on, Lan. Hold on. Be more patient. Be more patient. I hate to lose money. I hate to lose money. So I'll be more patient. I'll be more patient. I don't think it's going to go. Get stopped out. All right. So down it's going to go. We're going to put one in here. We're going to put a couple in here. I think a little bit more confident on the downside than I was on the upside. We'll put 3 of them in there. And we're going to leave one up here as a Hail Mary. And take one off. Put it right up there. We're just going to leave it up there. All right. We're not going to trail it. We're not going to do anything. Just going to leave it up there. We're going to see if this market won't turn around, come all the way back down. Let's turn on the bulls and bears. We're going to do bulls and bears. Oh, bulls and bears is on. So let's go turn on the blue light. Should we attach one of these to the blue light? If it gives us an opportunity, I don't know if it's going to give us an opportunity. It might turn around and start trying to go back up. Stop us out. Just stopped us out. We got our one up here. We're going to put that one on the blue light. It's just going to go up there and bounce around, go sideways. It's not going to give us a good, solid, fast, hard trend back down. Come on, you rotten little booger. Give us the little flip-flop. That's bullish right there. When you get that little flip-flop like that, you go back and look in time. And when you see 2 arrows like that on the ATR, the average true range, that's usually a flip-flop to the last arrow. So that's bullish. That's strongly bullish. So are we going to reverse our trade? No. Now we're going to get our hiney handed because it's going to turn around and fall again like I had. You're just going to play this stupid game, aren't you? Okay, we're going to do it again. Feed the bear. I'm going to put one of these on the blue light. We got whipped around a little bit. Trail blue light. Let's put that one on there. Let's leave one. Don't trail at all. And then we got the third one. We'll let it trail down on the yellow dots and see if it'll move down. Put one down here on the blue line. We could try and scalp one off if it come down and test that lower region once again. Take one off at $350 right there. All right, sit back and let her rock and roll. See what happens. We already got our hiney handed to us a little bit here. See if we can't get some of it back. Looking for it to fall. Come back to the, what did our S&P do? Because we want to put our wild eye, crazy eye on that one. And then I want to take you over and show you the stock market. We just play here in the futures market for a little bit here in the first couple of minutes. Look at that. It went right back up, created a triple top. Boom, boom, boom. Now it's flushing again. Come on, I want to see it back down here to the blue line. If it'll come down here, we'll put on a wild eye, crazy eye. This thing's just going to bounce around sideways up there. We're going to get stopped out again. All right, so much for that. So much for that. We thought it might come around and come back down and try to get back down here to the blue line. It's not going to do it right here. Not this time anyway. Now we're just going sideways. Had a nice, beautiful run up that we didn't catch because we were looking at another chart. Thought it might turn around and come back down. We tried once. We tried twice. Both times we got our heinies handed to us. And it didn't go for us. Now it's trying to go back up again. You want to try and go up again? No, I don't. I don't want to try and go up again. The third drive, Lance, second drive. Here's drive 1. Here's your counter trend. Now it's trying to make drive 2. Well, our stochastics, our MACD's breaking from red to green. Everything's a buy signal there. It's buy, buy, buy. I just don't trust it. I don't trust it. Look at volume. Volume's come way down from where it was when this last run. Volume's way down. Look at this. But it's starting to gain. It's green. Green, green, green volume. I don't trust it, though. It's a trap. It's a bull trap. I think it wants to come down to back to the VWAP. I think it wants to come back into that cone of probability. Cone of probability is like this right now. It's down here. It's trying to go up, trying to keep up the momentum. This is the Dow 30, the industrials. It's kind of got that little top in there. It's trying to break through. Bruce says sound is much better today. That's good. Glad the sound is sounding better. Kirk, you're the one that were saying that the sound was not good. I think I switched to a different sounding. I put a different headset on with a new microphone. So I'm trying different sound. We spent about an hour and a half last night trying to figure out what was wrong. And I think we pinpointed that my equipment, Kirk says the audio is better today. My equipment isn't compatible with Firefox in the new version of the software that we use to project onto YouTube for some reason. Trying to break down again. We're having problems here, Kirk. The market rallied really hard, and then we thought we might get a retracement, a pullback down to the blue VWAP line, and we had two failures. We took it here and tried to go short and got stopped out. We took it here and tried to go short, got stopped out. Now it's trying to go long again right here. It's testing this previous high, and we're looking for it to maybe break down one more time. I don't know if I want to try and take it, but I'm trying to see if it wants to break those blue lights or the yellow dots, and we'll try one more time to go take a short position down to back to the VWAP. But it's just holding on to its strength up there. It rallied up hard this morning. Look at this. That was beautiful. We missed it, of course. We were looking at a different chart. But we were looking at the NASDAQ, which actually flushed this morning. So it came down. Well, yeah, it came. Look at this. It's clear back here. Look at this. This was the flush from this morning on the opening bell. And that's what we were kind of analyzing these markets over here. So we missed that rise on the NASDAQ. But look, now this stupid thing's just going sideways. Look at all the moving averages just stacked on top of each other. It's not going anywhere. So now we're back over here. This thing's not going anywhere either. All right, it's boring. What we've got in the news, just to bring you guys up to speed again, we got on the news. Look at this. It looks like January 6th. There are feds everywhere. Fed, 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 fed. The whole day is full of feds. That was a joke, January 6th joke. You get it? The whole crowd was full of feds. All right. So we got lots of feds speaking today. So I think there's going to be a lot of indecision. And FOMC minutes are going to move the market big. We want to put a wild eye, crazy eye, iron butterfly on the S&P. But I wanted to do it when the market got back down here to the, I wanted to see the market come back down into the VWAP. And so I've been waiting for it to come down and test that VWAP one more time. And that's where I want to put my wild eye, crazy eye, iron butterfly on. But it's just hanging out up there. It's not going anywhere. We could put it on up there. We could put it on up there. But I think we want to have the wild eye, crazy eye, the sold options taken off by the time the Fed speaks. We take those off, and then, well, I don't know. We could leave them on. We take them off and put them on again. Take them off when it hits 25% profit, and then put them back on again. We don't really care if the market moves because we're protected with our other options. I don't know. I really like to do it down here. We've had better luck putting it on when it comes down to the blue line. But because that's the delta cone of probability, right? That's the center. We want to be kind of in that center. Of course, if the center's moved and it's now up here, man, let's watch this. While we wait, let's go over. I want to show you something else. All right. Now that Kirk's here, we can start class. Just kidding. Kirk, you missed the first part. It's okay, though. It's okay, though. All right. Let's come in here, and I want to show you this one. Okay. I want to bring this up. Now, if you guys, this is the stock market version. The other, of course, we were looking at the futures version. This is the skew. Now, remember, let's see if I can. This is the skew. This is the S&P. This is SVOL. We're going to talk about SVOL. This is the VIX. All right. So what I want to do is I want to bring up not all four of them at once because it's too small on the screen. So I'm going to minimize the VIX. Let's minimize the VIX for right now. No, the VIX is the one I want to talk about. SVOL, skew. Okay, let's start with the VIX. All right, here is the VIX. Now remember the VIX. No, I want to start with the SVOL. No, I want to start with the VIX. VIX is just volatility. It's just a volatility scale. That's all it is. All right. It tells you when the market is volatile. And you can see that the market's been very volatile lately. It's been real quiet all back in here in comparison, right? And it's been a little bit more volatile in here, right? We're seeing some volatility. That's really all this tells you. Is the market volatile? Yes, we're seeing volatility. Right here, we had a good amount of volatility. It doesn't look like a good amount of volatility because of this one. That's like almost unprecedented. Now, I made $10,000 on that trade right there. Not to brag, just saying the facts, all right? Just saying the facts. And if you look back in time, it doesn't do that very often. See? Usually it does this kind of stuff. This is considered big. This is considered huge. All right, huge volatility. Look at all this. These are big volatility moves. Big, big, big volatility moves in the market. Look at that big volatility move. See that? That's what this is. Now, the S&P is not going back with me in time. You could go back and line these things up. But you can see where all these big volatility moves compared to, oh my goodness, this one. Holy smoke-a-roonies. What happened there? Massive volatility through here. And that thing scared me a little bit, I have to admit. A little bit of a scare there, all right? But nonetheless, I still made a little bit of money on it. Could have made 10 times more, but I got scared, all right? I got scared. I got to admit, I got scared. That scared me. And now I made good money on this one. Made about, I can't remember, 3 or 4 grand on that one. And I've already made a couple grand on this one, all right? And I'm going to show you how. because this market has a tendency to make these little fluffs, right? Whoop, and then they come right back down to the mean. Woo, and then come back down to the mean, and then woo, and then they come back down to the mean, because all it is measuring volatility. But you can trade this. You can trade volatility. It's designed to be traded. Now, you and I probably not going to trade it, right? We're not going to go trade the VIX. We could, and you can do that if you want to. You can go investigate that a little bit and trade the VIX if you want. But for the most part, we're not going to trade the VIX. Well, if you're not trading the VIX, Lan, how do you make money on it? I let somebody else trade the VIX, and then I just give them my money to trade it. How's that sound for a wimpy trader? I don't trade it. I let somebody else. I let the pros trade it for me. I just give them my money, and then they trade it for me. But actually, not really. Yeah, that's kind of what's happening. But I give it to them strategically. All right, I strategically give them my money, and so what we're looking for here is we're looking for the VIX tells you the volatility of the S&P, basically. All right. So we're getting pretty volatile right in here. A lot of questions. We got the elections coming up, and the elections cause the market to have these volatility runs like this. All right. And we can get 3 or 4, 5, 6 bars like that. Not uncommon to get 10, 15 bars like that. You go back and look and see what it's been like. See, when you get this thing straight, it doesn't, because of that one great big thing, it pushed it all the way. It's scaling it. See, and then when you get that one off the screen, these pop up real big. Now you see what these look like, and these are big. These are big moves, not in comparison to the big giant one, but they're big moves. All right. So when the market gets up like that, the thing that you want to understand is that the market goes up into these zones, but they always turn around and come back down. Not always, but they have ever since beginning. Okay, so always so far, they've come back down. Doesn't mean volatility can't go to the moon and just stay there. Certainly can. It just hasn't done it yet. It's always come back down. All right, as much as it goes up, it always comes back down. Now, if you got something that's that predictable, that goes up and then always comes back down, goes up, always comes back down, goes up, always comes back down. That's pretty predictable. Wouldn't that be fun to trade? Goes up, always comes back down. Goes up, always comes back down. Goes up, always comes back down. Always comes back down. Show me a time where it didn't come back down. Goes up, comes 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 back down. Goes up, big, massive, comes back down. So when this stock did this and it went up, I pumped in a whole bunch of money. Right? And then it kept going and it kept going and it kept going. And I got scared and I pulled my money out. And then I saw it turn around and start to come back down. And I put my money back in about the same spot I got out. And so when it came down, I made about 10 grand. I made about $10,000 right there. All right. Because it went up and then I put my money in, anticipating it come down. It went way up and it scared me. So I took my money out about right here, but well, right about in here. And then it went way up there. And then when it came back down, I should have, I don't know. I think I did the right thing because it scared me bad. I mean, I would have been down big time way up there. And I put it back in here and then wrote it all the way back down for 10 grand. But how did I do it? Again, I didn't do it in the VIX. I did it over in the S-ball. Okay. Now, let me get rid of all these arrows. So given that, it has nothing to do with the direction of the market. The market, this is just volatility down here. And it's telling you that this right now, the market is scared to death, right? Very, very volatile through here. Market doesn't know what to do. It's very scared. That's why we're getting lots of these big bars, lots of movement down here on the VIX. So let's come down here and I want to show you the S-vol. Now the S-vol, if I turn it upside down, okay, let me get rid of the skew, or let's get rid of the S&P. So we're going to take the S&P and we're going to minimize that one. Okay, so now we got S-vol, delete all circles, and we got the skew. And we're going to line those up so they're right in front of each other. Okay, so why is that not lining up a little bit better? My August is not lined up with my other August. There we go. So I got these lined up. So you can see that this is the VIX. So that's the one we've been looking at. And then this is the S-vol, which you can see is upside down. It's just upside down from what the VIX is. It's the exact same thing. But look at how the VIX and the S-vol kind of trade together. All right, a little bit trade together because it's based on it. Now, not completely, because the S-vol has a lot more things involved in it than just the VIX, but it's primarily the VIX. It's got some bonds in it and some stuff to stabilize it. Plus, they use options on the S-vol. Now, S-vol, now you're not going to have the VIX and you're not going to have the skew unless you're in the real money account. It doesn't show up in the demo account because they're paid. All right. So as this thing moves back and forth, it's mirroring the VIX to some degree. So it always comes back to its mean. Not always. It doesn't have to. It just always has. All right. Just always has. Doesn't mean it's going to do it. Someday it might go down there and never come back. All right. But if you look, it always kind of stays in this little channel up in here. Now, the great thing about it is if you put money into this market, see how it stays in the kind of that little channel. It likes that little channel. And if we go back here farther, that little channel, that's the channel. Now, it breaks out of that channel every now and again, comes down here. But notice it doesn't go above the channel. That's how far back we're going to go. Clear back to 20. There we go, back to the channel. Now, this is the VIX, and they've got kind of things. There's where we're above the channel, back in here. But it's not been above the channel since clear back in March of 2022. But that's okay if it goes above the channel. We don't care if it goes above the channel. All right? We just kind of want it to stay inside that little channel right there. If it goes above it, that's okay. If it goes outside of it, that's okay too, because we're going to trade the channel. Now, I'm going to show you something that's really cool about this. Now, if you haven't started to get chills up your back at this point, you're not a trader. This should just like make you so excited you can't stand it. You're just like, wow, this is the greatest thing I've ever seen. This is greater than sliced bread. All right. So the market has come down out of the channel. So I put a lot of money in here. Well, I don't know. Depends on what a lot of money is to you. It's a lot of money to me. I'm not going to tell you the dollar amount. But yesterday on this little pop back, see how just enlarge it. See where it came back? The amount of money I put in there from where I put it in to where it's at made me $2,000. Okay. And I'm going to anticipate that that's going to come all the way back to here. It'll come back eventually back up into the channel. Will it? Well, maybe not. It might stay out and hang around down here for a long time. Does it? I don't care. I don't care. I don't care if it gives me that mean and stony stare, right? We don't care because we bought it down here. And we know that anything down here is really extreme. This is very extreme down here. Anything down here. I traded this one too, made a bunch of money. All right. Made a bunch of money on this little drop as it came back into the channel. Came back up into the channel. I didn't put as much money into it here as I've put into it here. I got a lot more money into it now because I've made, like, I started trading this back around in here. And I've made, maybe even a little farther back than that. I started doing this, yeah, probably around the first, probably back in here is when I started trading it. Now, I wasn't trading the little drops. I didn't drop there. But this, because if the market hangs out in here, I'm going to show you something really cool. You guys are just going to fall all over yourselves to get to this thing. Let's go over here. Let's come over here to, not that one, this one. Let me show you something. S-vol. This is S-vol on FinViz. All right. So you slide down here and see what all these little D's are? D stands for dividend. Look, it pays dividends every 30 days. Every 30 days it pays dividends. Boom, 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 just like clockwork. Just like clockwork. And look how much it pays. Look at that number right there. Dividend TTM, trailing 12-month period on average. Look at that number. Look at that number. Do you know what that number is? That's the interest rate you're getting on your money that's sitting in S-vol. 16.63% on average over the last year. 16% return on your money just because it was sitting in SVOL. Do you understand how much money that is? That's a lot of money. Okay, 16%. Let's say, just for kicks and giggles, that you got $250,000 in there. 250. 1, 2, 3. And a lot of people, that's all they've saved for their whole. Now, I'm not saying that you should put your whole $250,000 in there if that's all you got. But if you take that times 16.3, 16.3.63, Lan, you can't type. 16.63% equals. So on my little calculator, if you put $250,000 in there and you just left it and didn't even play the little ups and downs like I do, and just collected the dividends on $250,000 in there, that would be $41,000 a year. Now, many retirees could retire on that. They could live on $41,000 plus their whatever else they've got coming in on this, that, and the other thing, retirement. That's $250,000, and that might be all the money some people have saved for their entire retirement. And they've been told they have to have $1 million or $2 million to live a decent lifestyle with their Social Security coming in. Now, again, I'm not advocating, and I'm not a financial advisor. I'm some stupid guy on YouTube. So don't take my opinion on anything. Just because I do it doesn't mean you should. All right. I have $250,000 in SVOL. And my interest rate is 16.63%. Now, it's not by any stretch of the imagination my entire portfolio, but it's a good amount of money, right? And my dividends, if I hold it for a whole year and don't do anything but just hold it in there for a whole year, is $41,000 at this rate on $250,000. So you investors are looking at this and going, wow, that's pretty cool. The problem with this strategy, and I'm going to tell you, you can turn the problem with this strategy into a good thing. You can turn the problem into a good thing. If you put $250,000 in here, not saying you should. If you put $250,000 in here and just live off the dividends, okay, you're getting $40,000 a year off the dividends. That's pretty good money. But if you want to play this volatility like I do, you can add another 10, 20, maybe. I don't know. Can't give you any. Just telling you what I've done. Add an extra $10,000 or $20,000 to that every year. 40, 50, 60 on $250,000. You could get up into the $50,000, $60,000 range if you play it right. Because if you come back here and you play this thing, the SVOL, when it comes down into these big pits down in here like this, when it comes way down into these lower levels, it's always gone back to the channel. Doesn't mean it's going to, but it's volatility. It's not a company. It's just measuring the volatility of the markets, and that's what it is. And people use it as a hedge. Well, we can use it as a speculation tool. And so what I do is I start loading up. Now, I don't put all my money in at once because I understand how dividends work. I want to have my money in the market when it pays its dividends, right? So put your money in, pays your dividends, you can take your money back out as soon as it pays its dividends. The problem with that strategy is that markets have a tendency to fall about the same amount of money that the dividends pay out. So if you're like, well, I'm just going to chase dividends, and people do that, they'll come in and they'll say, oh, dividends are going to be X dividend date is tomorrow. I'm going to put my money in today. And then they'll get their X dividends counted. They'll get their dividends paid out, and then they'll take it back out. That's called dividend chasing, right? You can chase the dividends, and you can just put your money in just for the dividends. You don't have to be in for the whole month between dividends. They don't care. You just put it in the day before the dividends. You take it out the day before after the dividends, and you got your dividends on that money. That might not be such a bad idea here in SVOL. I do a little bit of that, but not completely. I move my money in and out of SVOL depending on whether the market's trending or not. So I dollar cost average with SVOL, because if it goes back up into the channel, that's where I collect my dividends. But I'm going to collect my dividends no matter what, where it's at. Wherever the market's at on that day, I collect my dividends. And then as the market moves up and down, in and out of this channel, I play the in and out of the channel. So it starts going down. When it goes up into the channel, I'm liquidating, taking my profits, taking profits. There's an article in Pit News Magazine about how I do that. If you guys don't have Pit News Magazine, what's wrong with you? What's wrong with you? Let me see if I can. I want to show you Pit News Magazine. So this is this month's October issue of Pit News Magazine. And if you come down here, it's a scary issue. I don't know. You might not want to get this issue because it's so scary. Look at this. It's got like witches and bears and, look at that dead guy. I'm sure that's probably scared everybody. They didn't dare go any further. But you come down here, right here, in this dynamic rebalancing income and capital preservation. So if you type that can bring you down here to my article. This is my article where I talk about dynamic rebalancing, a strategy for consistent income and capital preservation. If you read this article, it teaches you how I do this in SVOL. All right. It's the strategy I use in SVOL. And so SVOL, here, while we're here, I got something for you guys. For you guys who are, Bruce says Pit News Magazine is great. Yes, Pit News Magazine is great. All right, let me show you something cool. I got something fun for you here. I had Claire do this. Watch this, guys. Watch this. I think it'll work. We're going to try it. Let me know if it works.
Hey everyone, it's Claire here. Are you ready to take your trading knowledge to the next level? Welcome to Pit News Magazine, your trusted source for trading intelligence. Whether you're a seasoned trader or just starting out, this magazine delivers the insights you need to stay ahead of the market. Featuring articles from experts like Dr. Scott Brown, Aidan Gray, myself, and of course Mr. Lan Turner. Pit News brings you exclusive strategies, deep dives into market psychology, and powerful trading techniques. Find out about the exponential power of growth, seasonal trading secrets, and even Lan's latest wild eye, crazy eye iron butterfly strategy. Each issue is packed with expert trading strategies, top stock picks, key seasonal trading insights, and comprehensive analysis of commodity futures and ETFs. You'll also find tips on technical analysis, option strategies, and much more. No matter your trading interests, we've got you covered. And the best part? You can learn your way. Listen to each recorded article, read the full in-depth lessons, or watch our video breakdowns. It's trading education on your terms. Right now, we're offering a special deal. Get your first full year of Pit News for only $19.97. That's 50% off the regular price. 12 issues of powerful trading insights, backed by our 100% satisfaction guarantee. So, don't miss out on this limited time offer. Head to pitnews.com and subscribe today. Empower yourself, enrich your trading strategies, and stay informed with Pit News Magazine. Trading intelligence right at your fingertips. Okay, let's get back to Mr. Turner. Thanks for sticking with me.
All right, how was that? That was pretty cool, right? Those guys showed me how to do that last night, and I was like, I'm going to try that tomorrow. Could you hear it? Did it work? Did anybody hear that little thing from Claire? Pretty cool, right? Okay, so in Pit News Magazine, this article tells you how I do this strategy with the SVOL. So what we're going to do, basically, is we're going to liquidate, take our profits as the market goes back into the channel, right? The green, as it starts to go green, we're going to go back into the channel. We're going to take profits, take profits, take profits, take profits, take profits. And then when we get up into the channel, we're going to stop taking profits. Now, you're going to watch this and time it with your dividends. Now, the problem is that when you pay dividends, the market usually falls the same distance, the same amount of money as what the dividends pay out. So if they pay out 16%, it's going to drop probably 16%. Okay. So it's not like chasing dividends is really that profitable. So you just want to kind of hang on to it. Just if you're a dividend trader, you know that you just hang on to it and leave it and you ignore what the market actually does. And you're just going for the dividends because the dividends are paid out on the number of shares you have. Now, the problem with this strategy, if you're doing what I'm doing, which is you start to take your profits all the way back up that trend, by the time you get back up into the channel, you've got a lot less shares. All right. You got a lot less shares up in here than you do down at the bottom. So this is where you got a lot less shares and you got a whole bunch of shares in here. So I got a whole bunch of shares right now in anticipation of the trend coming back up in there. Now, we did our math. It was about 40,000, right, a year. If you take that 40,000 41,000 divided by 12, it ends up being about $3,400 a month. But on that retracement with $250,000 in there, you can come in here. Say you have 100,000 in there. Let's just come in and put 100,000 in preferences. How many would 100,000? Let's see. Let's go over to the trade. We're going to put in $100,000. I don't know how many shares that would be. How many? What's it trading at? 21. So I'm going to lose my numbers on my screen. So we got 21. It's trading at $21. So we're going to do 100. 1, 2, 3. 100,000 divided by 21.57. So that's 4,636 shares. So let's come into our dollar calculator. And let's just say it comes back to the midpoint, back to 50%. Let's get rid of all these arrows. Let's get all the circles out of there. Okay, so we're just going to say this market's going to come back to the midpoint. If it comes back to the midpoint with 100, with how many shares does that have to be? Has to be 4,636 shares. 4,636 shares. That would be with $100,000. So just returning back to the mean would be a $5,000 profit. Okay, so $5,000 profit. That's more money than what you're going to make. Well, $4,000 is what you're going to make on the dividend if you keep the full 100,000. No, not either. That was 250,000. If you have 100,000, let's see. Let me do my math again. You guys are probably well ahead of me. 100, 1, 2, 3, times 16%. We're just going to round at 16 divided by 12. Yeah, see, $1,300. So that's $1,300 you're going to make on your dividends, but you're going to make $5,000 on the retracement of that market pulling back to the mean. So the point that I'm trying to make here is that because you guys are well trained, because you've been working with me in this class, you are not just investors, you're also traders. So you can make the decision to take advantage of both trading the SVOL as well as investing in the SVOL. If you invest in the SVOL and just put your money in there and just hold it there, you'll make on $100,000 about $1,300 a month in dividends. That's good money, okay? But if you trade the SVOL in combination with getting the dividends, you can capitalize on this volatility, these volatility moves that come into the SVOL. Because as the SVOL falls, right, it generally so far, it's always returned back to the mean. And because it returned back to the mean, you can just ride that market back to the mean. And you're going to make a lot more money doing that than you are with the dividends, but you're going to make the dividends on top of it, but you're going to have to outweigh, hey, where am I going to have more shares? Because that's what it pays on. The dividends, you're going to get higher dividends when you get the shares. And then you're going to think, well, I'll just dividend chase. Well, it's not the best idea because the market has a tendency to fall after it pays the dividends. But if you don't care, because you're going to start dollar cost averaging in as the market falls and it comes back down, so you put all of your money in, right? You get your high dividends, the market flushes, you're going to lose a bunch, but then you're going to start, if you got you can have to have money to add back in. So if you put all your money in to get the dividends and the market falls, you don't have any more money to put back in to capture the retracement of the market coming back out. That's the point I'm trying to make. I think you get the idea of what you're playing against. Okay, you got the dividends that you want to collect, but you've also got the movement of the market that you can capitalize on as the market returns back to the mean. Now, it doesn't always make these big moves like this around dividend time. Dividend time usually gives you can go back and look. And I actually did the historical backtesting on this. I took all the history of SVOL, I put it into ChatGPT, and we ran some reports on it. And it was about 50-50. So you got about a 50-50 chance of the market dropping the same amount as what the dividends paid out. So if the dividends paid out 15%, the market has a 15% gap drop. So you're going to lose the amount of money that you get on the dividend as the market falls about 50% of the time on the SVOL. So that's a common thing. You can go look that up, search and talk about. You can do that with ChatGPT. I know some of you guys are still not using ChatGPT. You really need to go get involved in that in that maybe one day maybe we can do that tomorrow. Tomorrow is power hour day. Maybe we can sacrifice one of our power hour days, and what we can do is we can talk about how you can use Chat GPT, how I use Chat GPT. I'm not going to tell you how to use it. I'm going to show you how I use it. So maybe we'll do that tomorrow. I'll show you how I use Chat GPT, and I use it for research. I think I did that once before, where I kind of gave you guys some ideas of how you can use it. But it's a great little tool. You can go in there and just ask it a question, and it'll give you the answer. So you can ask it about dividends, and you can say, hey, teach me about dividends. I want to know, I heard that markets have a tendency to fall after the dividend date. Is that true? And then it'll kind of give you a little summary of how that all works. All right. So that is SVOL, and that's how I trade it. And I dollar cost average in all the way down, and then I turn around, and as it goes up, I dollar cost average back out, and then I take my dividends, and then I dollar cost average in all the way down, I dollar cost average in all the way back out. It's called accumulation and distribution. All right. Accumulation, distribution. That's another thing that you can put into Chat GPT. Say, Lan talked about accumulation, distribution. Now, or you can just go get my book, because I wrote it all down in the book. And then you can have it right there, and you can read how Lan does accumulation, distribution, and what Lan says about accumulation and distribution, and how that works with our other trading strategies, like the Elliott wave and the Fibonacci ruler. All right, it's all in the book. So just go get the book, and you got all that stuff. Okay. Now, the other thing I wanted to bring up your attention to is the skew. All right, the skew. So we're going to pull up the skew. That's the SVOL. And you know what? If you guys, this is in the stock market. SVOL is in the stock market. It's not in the futures market. So I would like to see you guys go in and just, it's pretty safe, all right, to do. So it's volatile. That's what it is. It's volatility. So the market's going to move, but it's pretty predictable. It's pretty, based on your knowledge and your training, you're going to be pretty well able to predict where this market's going to go. So just put $1,000 in. Okay, you know, it's not like you're going to lose the full $1,000. You're not going to lose, and you're going to get a dividend on it. You're going to get, 16%. Get $160 just leaving it in there for a year. I mean, a month. Yeah, 16. Well, if you put $1,000 in, 16%, you're going to make $160 in a year, right? Yeah, that's my math. So give it a shot. Put some money in there. All right. And start to trade with it. And before long, maybe you'll start feeling comfortable putting a little bit more, a little bit more, a little bit more. I would not go in and cannonball. Don't cannonball into this market. Don't say, oh, Lan's got $250,000 in this market, I'm going to go do that too. And put all your money in there, and then have one of these situations like this occur that scares the living pants off of you. And then you get out and you don't get back in like I did, and you lose all your money rather than make money. Okay. So don't, because it can scare the pants off of you. This market can scare you to death. You just got to understand how it works and do it over a long period of time and get your confidence up. All right. So just start small, put a couple grand in there, and just let it sit there and see what happens with the dividends. All right. So we're going to come in, and this is the skew. Now the skew, all this is telling us how many put options are being bought on the or in the Chicago. Let me see. I want to pull up, not the SVOL. Let's get rid of SVOL. We're done with SVOL. Talk about the S&P. So we got the S&P and not the VIX. I don't want that one either. Get rid of the VIX. I want the skew. Okay, so I'm going to put this up here. Okay, now I want you to think about the skew as if it, again, skew is not going to show up if you're using your demo account. It's got to be in live. So you got to be in the live account to see the skew. So the skew is, I want you to think about it like an indicator for the S&P 500. Okay, so look at the S&P 500. We're going to put that over the top of the skew. And then this is like, think of it as like stochastics or RSI. All right. And we're going to draw this trend. And we've always used 140 and 125. That's been kind of the standard of the industry for so long because the market has a tendency to stand there. But we've had so much volatility lately, I almost feel like we should change those numbers because it stays above them more than it's like it's got a new channel. So in fact, let's draw a second channel in here. I don't want to get rid of the first one, 140, 125, but if you look, it's kind of like we got a new channel in here. It's like this is more like what's going on lately. The market has been way more scared. So, but it's leaving this scare channel. And so what's happening is the market's getting really scared. And the way you know the market's scared is because the skew goes way up high above these channels that they create, okay? So where the normal is. So this is the old normal. This is kind of the new normal. So the new normal is that the market's very scared, okay? So what they do is they've been buying. Oh, let's see. I screwed up my measure it. They said put my two fingers in there. Get the microphone just right. Okay. All right. So the skew is how scared the market is, because what the skew is, as you can see up here, it's the CBOE, Chicago Board of Equities, or this is the options. How many put options are being purchased? All right. It's just the put options. How many put options are being purchased on the Chicago Board of Trade? And we know that the Chicago Board of Trade, because you all know we trade the Chicago Board of Trade all the time, right? That's what we do. We know that because you've been in this class, that the Chicago Board of Trade, that is where we hedge our stock markets, right? That's why they have the indexes in there, the NASDAQ, the Dow, the Russell, and the S&P, because we use that to hedge our trades over in the stock market. So if we're long-term investors and we have millions of dollars over in the S&P 500, well, we can hedge that over in the stock market by taking short positions when the market falls, so that we don't lose money over in the stock market and have to have a taxable event by getting in and out, in and out, in and out with all of our money. And it's hard to get in and out with millions and millions of dollars sometimes. So you just buy the S&P and then you trade over in the Chicago markets, where there are no pattern day trading rules. They've got high leverage. It's all this really great stuff. And you're just leveraging that against the long position you've got in the S&P. So if the market starts to fall, you sell over here. And because of the leverage, you can buy one or two contracts, covers $250,000. And then as it falls, you make money over here as you lose money over here. And so it offsets. All right. And that's how it's done. That's why farmers use it, right? Think about corn, for example. Farmer has a whole bunch of corn out in the field, and then if the price goes down, well, all the corn in his field goes down. So he goes into the Chicago Board of Trade. If corn starts to fall, he sells it here because he's got it here. It offsets his price, and he just stays level. He doesn't make he loses it over here and he makes it over here. So he can hedge it's called hedging, right? It's hedging his crop. That's why that's so important. Well, if you go over to the skew, a lot of people hedge. They hedge with options. So rather than just buying contracts, they'll buy options over there. And so if the market starts to fall, they buy put options. And so they've got put options, and this is how the big boys do it. This is how they protect themselves in the stock market. So they'll have all this money, teachers and firefighters and policemen and secretaries and all these people who put money into their 401ks every 2 weeks. Boom, 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 boom. They hope that these guys are taking care of their money, right? So they put it all into the S&P, but if the market flushes, they want to protect those firefighters' money. So what they do is they come over to the stock market, or over to the futures market, and buy put options. So if the market falls, they buy put options to protect themselves, just like they were hedging as if they were a corn farmer. And those put options show you how scared those people are. How scared are they that the market's going to fall? Well, the more put options they buy, the more scared they are, right? If they're pretty confident the market's going to rise, they're not buying put options. So down in here, you can see they weren't very scared, right? Market came all the way back down into the lower region because they weren't very scared. They weren't buying put options. The market's going to keep going down. They had already bought all their put options up in here, and they are already very scared up in here, buying lots of put options and in anticipation of a fall, right? And then this one here, they're really scared. They got scared right in here in anticipation of a fall, and now they're getting rid of their put options, right? Because the market looks like it's going to start to go back up again. We got drive 1, we got drive 2, we got counter trend, and it looks like they're going to go into drive 3, and they're taking off all their put options. Now they're still scared, but they're coming back into the new normal. This would be not scared at all down here, but that's where this was. To get all the way back down in there and take all their put options off, they'd have to come way back down into here. They still got a lot of put options. It's not like they're not scared. They're just not as scared as they were right here. They were pretty scared right in here. That's why they got way up there in that really high peak. They're really scared, but they started getting rid of their put options, right? So they're less scared right here, and the trend is down. So this coming down means they're less scared. They're not buying as many put options. So they're anticipating that they're not as scared. They think the market's going to go up. That's an indication that that market could go up because this is coming down, right? Less put options. They're not as scared. So they're not buying put options. If they were scared that that market was going to fall right here, these put options, they'd be way up here. Okay, they'd be way up here in this region up in here because they were really scared right there. That's as scared as they've ever been. Look at that. That's as scared as they've ever been. How far back would we have to go to see them be that scared again? Clear back here, back in February 14th. That's the last time they were that scared. And you keep going, keep going, keep going, keep going. Were they ever that scared before? It's been a long time. Clear back in June of 2021 was the last time they were that scared. Now, I'm not going back June 20. You could go back and see what that was. June 2021. We have to go back and find out where that was. But that date sounds familiar. 2021. January 2022. If you want to line that up, 2021, we're still got a long ways to go. 2021, July right there. So that they were scared to death right there. Right there. They were really super scared. June 24th, June 25th, June 24th of 2021. They were scared to death for some reason. And that market still went drive 1, drive 2, drive 3, drive 4 after that reset right there. It turned and went 4 drives high. That's just crazy. We don't generally get 4 drives. We generally only get 3. And that was after a big first drive here. How far back does that go? Ooh, look at that thing, man alive. Unbelievable. Anyway, they were very scared. So that's what that tells you. It's kind of a cool little tool, and you can look at it and find out that, hey, they're not very scared right now. Not buying. They got a bunch of them, but they're not as scared as they were back here. I think we're going to see. I think that's an indication that they feel confident this market's going to go up. I don't think we're going to see it come back into the Fibonacci sweet spot. If they should have options. If they thought it was going to come back down into that Fibonacci sweet spot, options would be way the heck up there. They'd at least be up to here, but they're not. But they're still high. I mean, don't get me wrong, because this is the old normal down here. This just happens to be the new normal. They just living scared. So that's skew. That's kind of a neat tool. So there's my Sunday school lesson for you today. SVOL. One of the best things I've ever come across. It's making me more money than anything I've ever done. And just showed you how I do it. And also skew, which shows you whether you should be scared or not. Okay, guys, I got a little Sunday school lesson for you beyond that. Let's go in. Don't fall in love with your trade. Don't fall in love with your trade. Perfect your exit strategy. Remember, the only way to bank a profit is to exit the trade. You got to take money off the table. When I'm trading SVOL, I take money off the table because I have to sacrifice some of my shares to dollar cost average in, dollar cost average out, accumulation, distribution. And then whatever money happens to be sitting in there when I get a big old dividend, great. But I'm playing the other side now too, because I make a lot more money trading the accumulation distribution on SVOL than I do with the dividends. And so, but I get good dividends on what I leave in there. And I don't take everything off as I go up. I mean, I got like a core, and you again in that article in Pit News Magazine, I talk about the core. So I maintain the core, and then I have another piece of it that I accumulate and distribute. It's called the satellite, the core and the satellite. And then I have the huge 16% dividend that's being paid on the core, and then I use the satellite to increase and decrease as the market goes up and down. Okay. So don't fall in love with your trade, though. Although I'm going to tell you, I am in love with SVOL. I am in love. Remember, the only way to bank a profit is to exit your trade. You got to get out sometimes, take your profits, but you can get back in. That's the really cool thing about that. Now, we didn't have time to go through all the really other fun stuff that we've got going, because we do have a whole bunch of stuff going on with all of our options, and we need to go through and talk about those. So tomorrow, though, I promised that we were going to do, what did I say we are going to do tomorrow? Now I forgot. Tomorrow, I said we were going to do something else. Oh, Chat GPT. Bruce says he likes Chat GPT, learning how to use it. Good. You should, they always say, AI is not going to take your jobs. AI is not going to take your jobs. Somebody, some human with AI is going to take your job. So if you're a guy that doesn't have and you don't use the AI system, because it's just a tool, it's just a tool. We've had lots of great, wonderful tools given to us throughout all of our lives. They've been inventing new things and giving us great new tools. And those people who adopt those new tools and stay savvy, they're able to advance and use those tools to help them get better. Well, AI is just another great tool. All right. So make sure you get a hold of it and learn how to do it. And I'm going to teach a little class on it tomorrow. I'll do that for tomorrow's power hour. So we'll do it at 12 o'clock tomorrow afternoon. I'll do a class on Chat GPT and how to use it with the financial markets to research the financial markets. So come and watch that, and you'll learn a little bit about Chat GPT and how you can use it and how I like to use it. And I'll even show you some pretty cool stuff. I'll show you how I analyze charts. I can show you how I do back testing in history. Like I told you on the SVOL, I use Chat GPT to put data into it, and then we did some research together. So I'll show you how I do that. So I'll show you some stuff that I like to do and I'm not a professional GPT by any stretch of the imagination, but I'll show you how I like to use it and how I figured out some stuff. So we'll have fun tomorrow playing with Chat GPT. And we'll try and, if we got time, we shouldn't spend the whole hour playing with Chat GPT, but I'll try and go through, and maybe rather than doing scalping tomorrow, we'll look at our options because we didn't get a chance to do that. We've also got to do seasonals. We got our seasonal stuff going on. We just got so many things going on in this class. You guys just have to come and attend, and we'll just get to it all eventually. And I love doing it. I'm having a lot of fun. This is really good time for me, and I hope you guys are having a good time too and learning something along the way. So take care, and we will see you guys tomorrow for Chat GPT. Please give me a thumbs up if you liked today's class. If they thought that SVOL lesson and the SKU lesson was a good one, thumbs up are always good. If you guys are new here, go ahead and hit that subscribe, and we'll see you in Pitt News Magazine. We're working really hard on the November issue. So I'm really excited to show you what's going on in November too, because we got some really good stuff in the November issue coming up already. So we'll see you then. All right, guys, take care.